We got our resident guest expert, the author of the Self-Directed Ira handbook, Mr. Matt Sorensen. Welcome.
Yeah, thanks.
All right.
I'm my guest. I'm a guest in my own house.
Yeah.
I love it. Okay. Well, we got this sweet new microphone, by the way. So if it sounds
cool.
like silky smooth,
that's why
you can thank the Blue Yeti microphone. It looks very pro. So
are we sponsored by them?
We're not yet, but you know, we're going to get a sponsorship, obviously. Well, we're excited for everyone to be here. This is a cool topic. I've written some articles and shot videos on this over the years. We do both of these things here. So we set up a ton of self-directed IRAs and a ton of solo 401ks, and we love them both, but each one is not for everyone. So we want to break down what your options are. Some people have an option. Some people don't. Some people are like, well, this is your only option. Some people could do either one. A lot of our clients actually do both. And I'll go over some of those reasons why you may want to, do a double play on your self-directed accounts with maybe a self-directed Roth IRA and a solo 401k. We'll get into why many of our clients do that. So
a little baseball analogy in there. Huh?
Yeah.
A double play.
A little double play. So, but we're going to bring Aaron up to bat here with some of your Q&A. So if you want to throw any pitch any questions to Aaron,
I'll be ready.
We'll see if he can send them over to me, and if I can actually score some runs and answer them. I don't know, see how long I can get with that one. We're gonna try and keep this light, though. I mean, that's just our style here. This is, talking about retirement accounts for some can be boring.
Mm-hmm.
I love it. I mean, let's be real. Many of you know our podcast or us is just in our company. We love this stuff, but we get it. For a lot of people, it can be a little boring. So we try to keep this somewhat entertaining. I mean, whether you're laughing with us or at us, we don't care as long as you're laughing. So, but we'll get through it. We got a lot of content. We'll get to the fine points on these different accounts, help those of you that are trying to decide which one to do. Or maybe some of you want to make a switch or, add one in that you're not doing. Let's just dive into it, and we'll get into the reasons why you should be doing one or the other and all the options. So, okay. I do have some slides I'm going to share. We are recording this. This is going to go up in a few days on the website. Make sure you're signed up for our newsletter at directedira.com. You can get signed up for the newsletter. You'll get notified when it goes up. And then also, we will add the slides as well. So you'll get access to the slides once the recording's up on the webpage. But I'm going to be sharing some slides here. We got some stuff on our website here. Quite honestly, I mean, I just pulled a lot of stuff I already have out there, and we're going to go through it today because we kind of hammered this quite a bit over the years. The biggest thing I want to try to accomplish today is make sure you understand the differences between the two and what you should be doing. Also, I want to dispel the myths. There is so much BS out there on solo 401ks in particular. They are overhyped. I have to fix them. I can't even tell you how many solo 401ks I've fixed over the years that are totally wrong. Somebody set it up wrong. Somebody operated it wrong.
Mm-hmm.
So I want to make sure those doing the solo can understand it, and also make sure people qualify for it properly, because it will come back to haunt you. I've had horror stories of clients set up other places that come back here to try and help us clean it up. And
it ain't pretty.
Yeah. And sometimes, as many of you know, you just can't polish a turd. So when you come lay it up here, what do you want me to do? Somebody just gives a piece of garbage that someone gave you, and you just have to kind of throw it away. So anyways, all right, I'll get off my soapbox there.
That's a good soapbox, though.
Okay.
That's good.
All right. Okay. Okay. Like I said, Aaron's going to be hitting some questions. I'm just going to go over a couple points here, and then we'll hit some questions, break down the differences. I got a chart and some tables here on the differences between the accounts.
Mm-hmm.
And then we'll go into scenarios and get your specific situations on the different accounts you should be using.
So just fire it over there in the Q&A box, please.
All right. Well, before we get started into the content, just remember I'm an attorney. So this is a boring Matt attorney coming out here for a moment to tell you this is not attorney-client privilege. This is not meant to be a substitute for professional advice. This is educational in nature. Go seek out your own professional licensed professionals for your specific transactions and situations. Okay. Also, this presentation is not to be used without the express written consent of Directed IRA, Directed Trust Company. All right. Another baseball joke there.
It was
Another baseball
keep rolling.
baseball joke. Okay, so
I mean, it's baseball season. So
it is. Okay.
It's all good.
Yeah. So I do have a book. This is the book, Self-Directed IRA Handbook. I have a chapter on solo 401ks in here that's over 50 pages itself, because it's a big part of self-directing. Of course, the book itself is called the Self-Directed IRA Handbook, so the rest of it's all about self-directed IRAs. We also have a law firm. My partner in the KQS Lawyers, along with my partner, Mark. We have a team there of over 50 people, and self-directed IRAs and advising clients that need legal advice, we do on a constant basis. It's also where we set up the solo 401k plans. Okay, you have to set up a plan for a solo 401k. Then we handle the accounts at Directed, though. We have a self-directed IRA summit that we do twice a year. We do the virtual, and we're adding more because they've been popular, but we have a live one coming up October 22nd and 23rd. It'll be in Scottsdale.
Yeah.
We're doing a golf tournament the day before with the charity involved, and full day,
awesome.
Full day Saturday. You got to be there live in person. We're not streaming it. We're not recording it. We're kind of getting back to the old school method of actually showing up together and talking. So, so that'll be October 22nd.
Go to sdirasummit.com. It is live up there, so you can check that out. And it'll be good. Like, we're going to have 3 different buckets. Like, you're very new to self-directing, you are currently self-directing and have some retirement, knowledge, and then those that would consider themselves more advanced. So we're going to have kind of a little bit of different flavors, a couple different breakouts and stuff. So it'll be cool.
Yeah, we'll have multiple things going at the same time, different people in different rooms. So it'll be good. We can try to get courses and content for everybody's knowledge level. All right. Now, I presume many of you know the differences between a self-directed IRA and a solo 401k. But I want to break them down here one by one. And some of you know this, so this may be review, but we got to get on the same page here for a moment. Okay, so just bear with me if you're like, I know this, Matt. All right. An IRA. This could be a Roth IRA, a traditional IRA. We'll talk about SEP IRAs a little bit later as they relate and compare to a solo 401k. Okay. Self-directed IRA. You can put $6,000 a year into an IRA, traditional or Roth. $6,000, that's it. What if I want to put 20 in, Matt? You can do 6. All right. Okay. If you're over 50 or older, you can put in an additional 1,000 for 7. All right. That's all you're going to do. While we do have many clients at Directed IRA that start at 0 and start throwing $6,000 in a year, we do have many clients like that. Most self-directed IRA clients are not starting at a new account at 0. Most self-directed IRAs are formed from a rollover of somewhere else. They got an IRA, they had a TD Ameritrade. They got an old employer 401k plan that's been at Fidelity. They roll over a chunk of money. Let's say it's $50,000 or $200,000. Let's say it's $50,000 because you want to invest in a private company. Let's say it's $200,000 because you're buying a single family rental or 2. Okay. They're rolling over just a portion that they want to self-direct. They're not really looking to put $6,000 in a year. They're working with their money they've already got. All right. So for a lot of people, think of where you're sitting. Am I thinking for an account that I want to put money into every year? Or am I thinking of my existing retirement plan dollars I already have? Okay. Because those are 2 different things. So just keep that in mind on IRAs. The vast majority of them are actually funded by a rollover of existing IRA dollars or maybe an old employer 401k.
That's good. Yeah, it could be like a thrift savings plan.
Yeah.
403B, 457, profit sharing plan, defined benefit plan. Like, those are kind of like all the others, like, just to correlate it back. Because a lot of you I know that are on have those kind of plans. That's an old type of employer plan. It would be considered a rollover. Yeah.
And here's the first thing for an IRA. You must have a custodian. When we get to the solo K, custodian's optional. You can do what's called self-trustee or solo 401k. But in the IRA space, you must have a custodian. So that's what Directed IRA is. And a custodian must be a bank, credit union, or trust company that's licensed. We're a trust company, we're licensed, regulated. And so we can serve as custodian and qualify under the tax rules for an IRA.
Hmm.
You have to have someone like us or TD or Fidelity or whoever, okay? You've got to have someone who's an actual custodian of the IRA. Now, what that means is, it doesn't mean you're just paying someone a fee every year. It means they have custody of your assets. Now, this is important for IRAs. If I've got an IRA, let's say directed IRA, who holds my cash? If it's uninvested, we do. Okay, directed IRA, we have your cash in our account. I mean, it's credited into your account, but we're holding that, right? So now again, we're audited, regulated. Make sure any self-directed IRA provider you're using is actually a licensed trust company or bank. There's a lot of third-party administrators and middlemen out there that scare the heck out of me that have your money and control over it, but they have no licenses or audits or anything like that. So in the self-directed IRA space, use a licensed audited company. So, but they're going to hold your money. They're also going to hold title to your assets. So when your IRA buys something, let's say Aaron's IRA, invests in a private placement, goes into a private company.
Yeah.
When he goes and buys those shares or units in that private placement in that company, it's going to be in the name of Directed Trust Company, FBO, Aaron Halderman, IRA.
Roth
okay?
IRA.
Roth IRA. Okay, all right. Aaron's a Roth guy. So it's not going to be in Aaron Halderman's name. It's going to be in his IRA's name, which is in custody. We have Directed Trust Company, FBO, which means for and on behalf of Aaron Halderman, Roth IRA. So we're holding and controlling it. When that private placement sends distributions, it's going to go into his account here at Directed IRA. When he sells those units, that money is going to go back into his IRA account here. Okay. So the custodian has custody and really ownership of the assets for the benefit of the account owner. All right. Now, because you have a custodian, it's easier.
Mm-hmm.
You're not doing anything. Sometimes it's you have to instruct us what to do. Like, hey, invest in this private placement. I need you to sign off on the subscription agreement. I need you to sign off on the docs. I need you to wire the money for my account, right? There's some coordination that does take some work and it's not as fun, but we've tried to simplify that as much as possible and make it easy. And a lot of times we help clients do it faster than they could do on their own because we do it all day long. So there's a custodian involved, but the good side of that is we're doing all the tax reporting. We're sending everything to the IRS on your account every year. If you take a distribution or do a Roth conversion, we do the 1099s for you. Okay. We've got that all down. And you're going to get all the tax reporting. We're sending the stuff to the IRS. So your IRA is going to be in compliance. It's much easier that way because when we contrast that to a solo K later, depending on how you've set up your solo K, you may be on your own. Okay. You better have your accountant involved or you better be one yourself to make sure that thing's getting administered properly. All right. Okay, the last preliminary point I'll say in an IRA, it's cheaper. A solo K is usually, there's going to be an upfront cost because you got to set up a plan. And then you're going to have some compliance with it year to year. Now, if you have a small solo K below 250 grand, you can get out of some filings I'll get into in a moment. But over time, for someone actually operating an IRA properly and a solo K properly, the solo K is always going to cost you more. Once you think in all the coordination of services you got to do, it's definitely going to be, the solo K is going to be more expensive. So the IRA is cheaper. Like our fee for an IRA here, $295. Okay, that's it. You have a processing fee when you're making investments, buying or selling something, but those range from $35 to $100 depending on the asset type. So generally you're paying $295 a year. In a solo K, once you take into the cost from an accounting standpoint, to help with your contributions and make sure that's reported properly on your business return and on your W-2s. If you take a distribution or a Roth conversion, you're gonna have 1099 fees that someone's gonna have to prepare.
Mm-hmm.
You're gonna have a 5,500, what's called on a solo K if you have over 250,000 of assets. There's a lot of these little pieces of tax reporting things that gotta happen. And if you're operating it right, that's gonna add up to more than $295 in services, I promise you. So just keep in mind, just in general, it's not always the case. And there's providers out there that will tell you the solo K is so cheap, you don't need to pay anything every year. Okay. Then you're not reporting it properly to the IRS probably. So, okay. So
you hit a lot. You hit on a lot of things. but we have some cool charts. So it's some good reference material that you can go back and do. So there's a lot of key things there. So just hang tight.
We only got an hour. Sorry. And I get so excited about this. I just want to tell you what
it's good.
Just want to go. Okay. All right. Let's take a minute here. Do you have any IRA questions that are just like questions about IRAs before I contrast to the solo K? Because we're going to hit some basics on the solo K. Then I'm going to do a side-by-side.
Yeah. So the biggest one is they have is can you contribute to multiple IRAs? Okay.
No. So the 6,000 limit, let's say you want to do a traditional IRA and a Roth IRA, you're not going to be able to do $6,000 into each. So you'd pick or choose that year what to do. Do I want to do a Roth IRA or a traditional IRA? Now, you can do a solo K and an IRA. And very common for many of our clients to do a solo K and a Roth IRA. And for high income earners to do a solo K and a backdoor Roth IRA. Okay. And that's many of our clients. I do that. And many of our clients are maxing out their solo K or 401k and doing a Roth IRA. And you could do a backdoor Roth IRA too. If you're like, well, Matt, I have too high of an income, I can't do a Roth IRA. No, you could potentially do a backdoor Roth IRA.
The one other thing we get a lot is, well, what if I'm currently employed?
Yeah.
So I'm not a small business owner. I have a 401k at my job.
Yeah.
And I'm contributing to that. I'm maxing that out. Can I also contribute to a self-directed IRA?
You can. You need to do a backdoor Roth IRA in that scenario, which is very common, very popular. We'll probably do a webinar on the backdoor Roth IRA. We have a podcast episode on the backdoor Roth IRA. If you go to the Directed IRA podcast, Mark and I have videos. We have a whole page on Directed IRA that outlines how the backdoor Roth IRA works. Just be careful when you go to YouTube and start searching around backdoor Roth IRA. I mean, just make sure you got Roth IRA in there. I don't want to be responsible for what you end up on. Okay, any other IRA questions?
Catch-up amounts.
Yeah.
Catch-up amounts. And what that means is like, if you're a certain age, can you contribute more?
Yeah.
What are the catch-up rules?
Yeah. So 50 and older, you get an extra $1,000. That's it. I mean, it's better than nothing, but.
And on the solo K side?
Solo K side, you get $6,500, 50 and older. Yeah. So on the contributions, we'll see in a minute here, as many of you probably know, the solo K crushes the IRA. If you want to get new dollars into a solo 401k, just on the employee side, you can put in $26,000 of income. If you make $26,000 in your business or on your W-2, if you're an S corp, you pay yourself at least 26. You're over 50, you can put in $26,000. For those of you under 50, let's say you're 40, you got $19,500, which is still pretty good. But all right, we ready for the solo K though? We kind of
I think
stumbled into it.
No, we're good. We're good on that. I mean, let me hit on this actually, because this is going to come up. It's already coming up. I got an IRA. I got a self-directed IRA. Now I want to move to a solo K.
Okay.
So that's like, can I do that?
Yeah.
I already have assets that I've invested in.
Okay.
Like that's, because obviously, I mean, cash is easy, but in this case, in most cases, it's you've invested it. So now you have an asset.
Yeah.
Now you want to convert to a solo K.
Yeah. Okay. Let's go over the self-directed IRA and getting to a solo K if you want. Let me just answer it now. We'll come back to it. As we talked about at the initial part, how do I fund a traditional IRA? Well, I can put new money in it as contributions. And for an IRA, I can also roll over an old 401k. I can roll a traditional IRA from somewhere else to a self-directed traditional IRA. Okay, you can do all that stuff. In a solo K, the big problem I see, and many people screw this up, again, they end up here for us to try and fix it. I'm like, yeah, someone told you something wrong. So, okay. Roth IRAs, if you're like, I already self-directed Roth IRA, I want to go to a Roth solo 401k. How do I do that? Write your congressman. You can't. All right. Roth IRAs are forever Roth IRAs. You will never get the Roth IRA into a solo K. You can move the Roth IRA to some other company, to a different custodian, but you cannot move Roth IRA funds or assets into a Roth solo K. All right. That's just a principal rule of Roth IRAs. They will always be Roth IRAs. Once it's Roth, it's always Roth. Okay. Now, that's different. If I have a Roth solo 401k, I can roll that out to a Roth IRA. You can go that way. And we have many clients that do that, particularly as they get older. There's many reasons why you would want to do that. We'll get into that here, but they will roll out. But you can't go Roth IRA. Let's say you have a traditional IRA, though. You can move that into a solo 401k in your traditional account under the solo K. I'm going to explain the solo K here. So you're like, dude, you haven't explained that yet. Sorry. That's a good question. I wanted to hit it.
You got to start with step one.
Yeah. So you could get your traditional IRAs cash or assets that could be transferred into the traditional account in the solo K. So only traditional dollars can get transferred or contributed over to a IRA dollars, I should say, into a solo K. Let's say you got a Roth 401k at a current employer or an old employer you left. You could roll that Roth 401k into a solo 401k Roth account though. Okay. All right, let me explain the solo 401k. I've already been talking about it. Let's go over what that is. See, IRAs are really easy because if you're an individual, you can have an IRA. Everyone qualifies for an IRA. Now, how much you can contribute each year, there's rules on that. And, when you can take the money out and all that, there's rules on that. But everyone can have an IRA. Not everyone can have a solo K. Okay. You have to qualify for a solo 401k. Now, what a solo 401k is it's a 401k, obviously, that's set up for someone who's self-employed with no employees, hence solo 401k. So what the IRS did about 12 years ago is they said, all right, we're going to simplify a bunch of things. For those of you that are self-employed out there, that you want a 401k just like, the Fortune 500 companies get, and even, the Dunder Mifflin may have for its employees. Like, we want you to have a 401k too. And we're going to make it easier for you. And the IRS refers to them as individual Ks or individual 401ks. But solo 401ks kind of turn into the industry term. So what they did is they're like, you can do this. If you're the only employee, we're going to make it really simple. And this is what this product is, this solo 401k. But you must have a business, a legit business. You can't just set up an LLC that does nothing, or a corporation that does nothing, have it create a 401k plan for you and be like, all right, I have a business. No, you don't. An entity is not a business. Does it have income? Is it on your tax return as a business? Because if it's not, the IRS is going to disallow the business that you think you have, and your solo 401k is going to go in the garbage can. This is probably the number one thing I see messed up is people are like, well, I want a solo 401k, but I don't have a business. And so they go set up an LLC or something that does nothing, that has no business, no income, nothing. They never even intended for it to have anything. And they go adopt a solo K, and there's all these online providers that do this. And cool, I have a solo 401k, but I don't have a business really. So remember, you must have a business. If you're like, Matt, I flip houses, I have no employees, maybe I work with some contractors here and there, but no employees. It's just me and my spouse maybe, or me and a business partner. That's totally fine. And in fact, your spouse could have an account in the solo K. So could your business partner. So let's start at step one. You must have a business. If you're sitting there thinking, I want a solo K and I don't have a business, it's not going to work right now. You need to think first, how do I have a business? Then how do I get a solo K? All right. Now, for those of you that have a business, and let's say like last one I did was a real estate agent, and he had pretty good income. You had actually been doing a SEP IRA for years, but wanted to get more in. And so we did a solo 401k because there's ways you can get more money in faster in a solo K than a SEP IRA. So think of a real estate agent, no employees, they're self-employed, whether you're just a sole proprietorship and you're doing Schedule C on your return, that's a small business. All right. That's totally cool. Whether you're an S corporation and you're paying yourself, that's, you're the only employee in it. That's a small business, of course, LLC as well. Here's what's not a business though. What's not a business, and is a common mistake as well, is an LLC that has rentals. If you have an LLC that has rental properties, that has rental income, well, that's a business, but it's investment income.
Mm-hmm.
See, 401ks are designed to benefit employees. You're not an employee to your rental properties, right? You're taking that in as rental income because you don't want to pay Medicare and Social Security tax on all that. So you do what everybody does that owns real estate. You book it as rental income and you don't have to pay into Medicare or Social Security on that. It's pretty great. Now, if you're like, but Matt, I want to have a business and I only have rental properties, there's some options there. If you have enough activity, you could create a separate management company, maybe just an LLC, it could even be a sole proprietorship, that your rental company pays some money over to manage the property. And that creates a legit business, which you will have to pay into Medicare and Social Security on that income over here now, that could then, that management company could then justify having a solo 401k. But your LLC that just has rentals.
That was a pure gold strategy. You just gave people. That was free. Entirely free.
That was a free webinar.
That was a freebie.
Free webinar. So that's something we do with some clients. If you're like, you got one rental property and that's it in an LLC, that's pretty aggressive. You want to talk to your attorney or CPA on that. If you got a few rentals, we think it's a legit thing to do. We would never do a management company for a client's rentals in our law firm. Never, except to support a strategy like this. Because someone really wants a solo K and has good reason to have it. Okay, so we got point one. You must have a business. Now that business is going to adopt a 401k plan. So this is your company here on the diagram. This is you that owns the business, and you put on a suit and tie to look good for it.
That was a nice touch. Yeah. That was a nice image.
And then the company creates the solo K. You do not adopt or create the solo K. You're an employee. Okay. Your business adopts and creates the solo K for the benefit of its employee, which is you. Okay. So, of course, you want to have the most generous 401k plan available because you're such a great employee and you need to be compensated well and have great benefits.
So generous.
Yeah. So here's what you can put in. As an employee, when you put money in, you'll see there we have two categories of how you put money in: employee contributions and employer contributions. An employee contribution, you can put in $19,500 a year. That's for 2020 and 2021. $19,500. Again, as we mentioned earlier, if you're 50 or over, you get an extra $6,500. You can actually do $26,000. Now, let's say you're 40, so you did your $19,500 as an employee contribution. Now that is dollar for dollar. So as long as you made $19,500, you can put in $19,500. If you're like, Matt, I'm a sole proprietor, I only made $10,000 this year once I expense everything. How much can I put in? $10,000 as an employee contribution. You can put a little match in as an employer. We'll get to that in a minute. But for an employee contribution, it's dollar for dollar on what you make. Let's say you're an S Corp, which is most common small business entity for most people out there, for certainly our clients in our law firm. If you're making at least 50 grand a year, you should have an S Corp. But you're going to get a W-2 out of your S Corp as the owner. You have to pay yourself a salary as an owner of your own business in an S Corp or a C Corp. But what you're going to get here is, let's say your W-2 was $10,000 there. How much can I put in the solo K? As an employee, 10 grand. Let's say my W-2 was $100,000. How much can I put in my solo K as an employee? 19.5. Okay, you're maxing out at 19.5 in terms of the employee contribution. But the cool thing about the solo K is that's not all.
But wait, there's more.
Yeah,
you're telling me there's more?
There's more. Okay, and for 3 easy payments, so you could put in more. In fact, you can put in up to 58,000. So what is that? You get another 28,500. You get a drop in here, or no, 38,500. Sorry, 38,500 that you get to put in here to get to a total of 58. So 58,000 is the 2020 and 2021 number for how much you can contribute to a solo K. So if I already put in 19.5 as an employee, I get another. Did I get the numbers right on that? 37,500. 58,000 minus 19.5.
Mm-hmm.
Okay. Check my math if you would. I'm going to keep saying it. So you got 37,500. All right. Now that's how much the employer can put in. Now the employer contribution is 25% of the W-2 for S Corps, 20% on sole proprietorships. So let's say you made 100 grand, your W-2 and your small business that you paid yourself was $100,000. We can do the math easy on this. How much can I put as an employee? 19.5. Did I do the math right, by the way, on the 37.5? 38.5. Okay, that's right. Okay, so I have 100,000 W-2. I can, as an employee, I can put in 19.5. Now the employer, I got 38,500 left. Aaron corrected my math. And the employer can put that in. That's how much I could do max. But I can't put that in entirely. The way you calculate the employer is 25% on the employee's wages or self-employment income. So if my wage income from my small business was 100 grand, all right, I can put in 25% of that as an employer match, 25 grand. So I put in 19.5 as an employee, 25 grand as employer. Now I didn't max out at 58 because I only took 100,000. To max out at 58, you got to be about 140,000 of income approximately, to where you're going to be able to max it and do the 58,000 total. But that's how the sole OK works. So remember, 19.5 is the max, just dollar for dollar on what you've made, either self-employment income for sole props, or even at single member LLCs that basically are sole props. And then, and for S Corps, it's on the W-2. Okay. So some people are like, but Matt, I have a ton of profit in my S Corp. Do I get to count that? No, it's off your W-2.
It's pretty cool though. You still got 44.5 total in there out of 100K. Yeah. Like that's pretty sweet. 100K, got 44.5 total.
Even if you're an S Corp and you paid yourself a $50,000 salary, think about it. You're going to put in 19.5 as an employee.
Yeah.
And then 25% of 50 grand, which, what is that? 12,500. I mean, you're putting over 30 grand into your sole OK off 50,000 of wage income.
Yeah.
That's pretty nice. And so you can see why for someone who's wanting to get more money in to a retirement account to self-direct, of course, that's what we want you to do. But I mean, you go day trade stocks, whatever you want to do. But someone's wanting to get more money in each year of contributions. The sole OK is way better than the IRA. Okay. I mean, I'm only getting $6,000 a year in an IRA. But if you go back, remember what I said about an IRA, most people doing an IRA are not starting at zero. They're rollovers. They already got their chunk of money that they want to invest. Come over here to a solo 401k though. And if it's like, Matt, I'm at zero, or I don't have, I got 20 grand maybe in an IRA. It's not enough to really go do the self-directed investments I want to do. How do I get more? Are you self-employed? Yep. Do you have employees? Nope. Boom. You are definitely doing a solo OK. Like we want you. That's a no-brainer because you're going to be able to throw more money into it.
So let's just break down a couple things just to slow it down and recap because we got a lot of repeat questions. And so again, legit business. Okay. It could be a side hustle still, but it has to be a legit business. You're an employee receiving W-2 income. Like it's okay if you're at a full-time job as well. Legit business.
Oh yeah. Okay. We have lots of clients that have a side hustle.
Totally cool.
And you're driving Uber, you got an eBay store, an Amazon shop, you tailor suits on the side, you teach music lessons. I don't care. You got a little side hustle, and that even if you got a 401k at a day job, and even if they do some matching for you over there, you can still do a solo OK. But you've got to have a legit business, and this legit business is going to show up on a tax return somewhere to the IRS. It's either if it's an S Corp, you're going to file your 1120S S Corp return. If it's a partnership LLC, it's going to be a 1065. Or if it's a sole proprietorship, single member LLC, it's going to be on Schedule C of your personal return. If you're not filing one of those, you do not have a business. Okay. So you've got to have a legit business. I don't care if it's a side hustle or what, neither is the IRS. That's the only requirement is it's a legitimate business. Now, let me put a caveat in there. I've had a few clients over the years that are like, well, I don't have a business, but I'm starting one. Can I do a solo OK? Yeah, you can. I don't care if you have nothing in it, but you better really have a business. So I have some clients be like, well, I want to keep the solo K, but I really didn't do anything in the business. I never really took it off the ground. It just got busy and I just didn't really want to do it. But I have the solo K now. Can I still have the solo K? No. The IRS has something called the hobby loss rules. In 3 years, if that business isn't doing anything and you just got some losses and no income, nothing's going on, you don't have a business. The IRS is going to disallow that and say it's a hobby. Can someone with a hobby have a solo K? No. All right. I mean, that'd be cool, but no. All right. You've got to have a legit business. So that day of reckoning could come. So just make sure you do have a business. Now, let's say you're in that boat. That's cool. You're just going to roll out, probably do a self-directed IRA actually. And you can still keep those funds you may have rolled over into it to get it going. And that's an important point too. Let me say that. The solo K can also get traditional IRA rollovers. So if you have a traditional IRA or an old employer 401k with traditional funds, that can get rolled into the solo K. Even Roth 401k funds from somewhere else could get rolled into the solo 401k's Roth account, which we'll talk about Roth and traditional accounts in a solo K in a minute. Remember, the only roadblock is if you have a Roth IRA, you will always have a Roth IRA. Roth IRA cannot be rolled into a solo 401k Roth account.
But the other way around?
Other way around is totally fine. I legitimately but back during President Obama's time, I still go to a lot of industry stuff for retirement accounts, and he had a retirement plan czar that I was in a meeting with. This is part of a bigger conference. Okay, it's not like just personal one-on-one or anything, but I asked the question.
Smoking cigars.
I asked the question. Okay, about like, what's the deal? like, what's the deal? Why can't you roll a Roth IRA into a Roth 401k? And his answer was, well, a lot of people have enough complaint about it. We're aware of it. It doesn't make sense. Frankly, it confuses people and we'd like to fix it, but it's not a big enough issue that anybody cares enough about it to do anything. He said it in a much more politically correct way, but that was the gist of it. So hopefully we'll see that change as retirement legislation goes around and more Roth IRAs and Roth 401ks are more and more popular, because really they've only been around for, Roth 401ks in particular for the last 10 years. Roth IRAs have been around for 20 plus, but Roth 401ks are still pretty new in government terms.
Okay, a couple other repeat questions. How can I get multiple business partners into this, multiple family members into my solo 401k?
Totally. Yeah. I mean, the most common we see is a spouse. Now, this spouse would actually be an employee in the business. Okay. It's not just meant for your kids or your spouse. It's meant for employees. So are they an employee in the business? All right. So if you're going to
thumbs up.
Yeah. If they're an employee in the business, then yeah, they're totally cool.
Not employee?
Yeah.
2 thumbs down.
Are your kids employees in the business? No. Okay. Then they're not going to be able to participate. Now, we love paying kids from a business anyways. There's some tricks to this, but I don't want to get too far into the tax strategies, but many of our S Corp owners, which would be most small business owners, you're typically in an S corporation. Joe Biden had an S corporation, but after, so like common. All right. And the S corporation, it's a lot of people, particularly for your kids under age 18, we're going to pay them out of a family management company. So if you're wanting to add kids into your solo K, you got a lot more coordination on your plan and setup. And so if you're like, no, it's just for me and I own the business, got no employees, that's pretty straightforward and clean. If you're like, I want my spouse in there, I want all my kids and I want kids accounts in there. My business partner wants to do the same. Can we do that? Yeah. But just remember, you're stressing the limits of it. So you're going to have a lot of complications on how you execute that to do it. Possible, just a little more tricky to pull off. But once you get it set up and know how to move the pieces each year, it's just the same little mechanism on getting it funded and contributing. And you're going to keep separate accounts too. So let me make that point. Again, the most common would be like husband and wife, you and a spouse, let's say. So you've got your account, but your spouse has their own separate account, just like, here at Directed, at the 401k. Aaron has an account, I have an account and a separate account. All right. At Dunder Mifflin, their 401k plan, Michael Scott's got an account. All right.
Good account, good size account.
Yeah. Yeah. I mean, Michael Scott.
Jim's doing pretty good too these days.
Jim's got his own account. All right. And those are separate accounts. They make separate investment decisions. The money's separate. The income on each one is separate. So you're going to have separate accounts for each person in a solo 401k.
Okay. Last thing before you pull up the next slide. So QRP or EQRP or qualified retirement plan, a lot of terms thrown out there. There's a lot of marketing stuff that's out there and kind of be a little bit misleading, misguiding. That's a solo K. That's a solo 401k is what they're referring to. So don't get like mixed up in that or thinking like this is a new strategy or never before seen strategy. That's just a marketing slang term, if you will, that they've published and are rolling with, or maybe even trademarked. And it's a solo K is what it's going to be set up.
Yeah. And we've been doing these solo Ks for quite a long time here, way before Directed Ira. We've been doing it in our law firm. And this has the most amount of misinformation of anything we do, period.
Mm-hmm.
The solo 401k. The reason why is there's a lot of promoters out there who sell.
That's a good term.
They just sell.
Yeah.
And they're not really caring about, is this the right fit? Did I do it right? They're not licensed. All right. They have no credentials. There's so many of these out there on the web in particular that scare us. And so just be careful who you're working with. Make sure there's some professional license involved or something, because I see these things like the EQRP and QRP.
Mm-hmm.
They're just trying to make it sound like it's something different than a solo 401k, because everyone does a solo 401k. It's a solo 401k. I don't care how many times they tell you it's not. Well, we've done something different in our plan documents. It's different. Okay, is there one participant in this plan? Or is it only business owners? Yes, it's a solo K. I mean, I don't care what you call it. It's for purposes of what we're talking about and all the rules is a solo K. Now there's pension plans and cash balance plans. Those are different. Defined benefit plans. Those are different. Those are operating under pension rules, but trust me, you're paying 10 grand plus to do one of those.
And you're a pretty high income earner typically, like several $100,000.
Yeah.
To really max those out to benefit from that, to even like incur the expense and management of it all, really.
Yeah. And if you want to, if you're like Matt, 58 grand's not enough. Yeah. I'm high income. I'm making $500,000 or more a year. I want to do more.
Probably DB.
Then we do a DB cash balance plan type combo. We can get you in the direction on that. We can handle the self-directed account here. We'll just have someone else do the cash balance plan, because those have to have what's called an actuary. You have to do testing. There's special sign-offs that have to happen annually on that plan that requires what's called an actuary. Solo Ks are cool. What basically Iras said on solo Ks is we're going to make it simple, because we know this is just one self-employed business owner. We know there's no employees we got to worry about, and the business owner taking advantage of the plan at the expense of their employees. So you're totally cool. Like has been simplified. Let me give you one example. 401ks in general every year have to file what's called a 5,500 tax return. In solo 401ks, a 5,500 is only required when you have 250,000 or more of assets, or the year that you close the plan, even if you're less than 250. So in a solo 401k, you don't need to file a 5,500 until you hit 250,000 of assets in the plan. And when you do, you actually file what's called a 5,500 EZ. It's an easier filing.
Does that mean it's easy?
It's like, is that like easy?
Bad joke.
Yeah, easy. For those of you in California, what is it called? The Easy Pass or Easy?
Yeah.
Easy Pass.
Fast Pass.
Fast Pass. I don't know.
That's Disneyland. I'm just kidding.
Oh,
it's an Easy Pass.
So now solo K, again, you can self-direct it. Now the thing on the solo K that's also unique, obviously you can get more money in a solo K. You can self-trustee it and self-administer. You don't have to have a custodian. Now we'll do custodial accounts at Directed, because many clients want us to do the work on tracking the money, getting statements, doing 1099s if they do distributions, like they need that help and want that. So many of our solo K clients that we set up actually do a custodial account, but you don't have to. You can just have a bank checking account right out of the solo K that you're the trustee of, and you can sign off on it. See, in your IRA, we're actually the trustee at Directed IRA. The custodian is effectively the trustee. On the other hand, in a solo 401k, the business owner can be the trustee and almost always is. You could appoint some other party, but generally the business owner themselves is going to be the trustee. All right, let me get into some other questions that sometimes come up. Sometimes we'll get questions that'll say, Matt, I've got a business with employees, and I had a client that did this. They used a competitor company of ours whose name I won't, use here for fear of a lawsuit.
Remain nameless.
Yeah. I want to say to protect the innocent, but they were not innocent. They totally have caused the problem. Okay. What they did is this client had a property management business with, 12 employees approximately. They also had a business that they fixed and flipped properties. And, you got to be careful in that, because if you have any business with employees, period, that you own 50% or more of, you cannot have a solo K. And what they were told was, no, you can do it. Just do it in the company you don't have employees in. Do it in your fix and flip entity, let's say, that, you don't have any employees in. Does that work? No. All right. The IRS is like, we don't care. If you own any business 50% or more, you ain't doing a solo K, period. If you have a business 50% or more with employees in it. Now, there's one exception to that for a spousal situation. Let's say you and your spouse are both self-employed or have your own companies, and one of the spouses, let's do an easy example. Let's say you're a real estate agent and your spouse is a doctor. Okay, your spouse, doctor, her medical practice has employees, and can she do a solo K? No, she's gonna have to do a 401k, a regular one that employees can participate in. They can do 19.5, but there's no way in heck you're going to match and do 25% of wages as a contribution to get up to 58. Because if you do it for you got to do it for every employee, and nobody does that. That's way too costly. So the solo K just doesn't work when you have employees. It's super complicated anyways. You have to offer mutual funds and stocks and other investments for them as well. So it's really hard to pull off with employees. So your spouse is the doctor. Now let's say you're a real estate agent with no employees. Can I set up a solo K in my own S corp that gets all my real estate income? Yeah. And you can have a solo K just for you. Now, can your spouse come over and have an account in your solo K, even if she's an employee and does some work with you in your real estate business? No. Okay. Spouse cannot participate in it, but you could if you have your own separate business with no employees. These can't be businesses that transact between each other or incomes going back and forth. They have to really be independent, separate businesses. But that's a option. Excuse me. We've done that for many clients over the years. For those, entrepreneurs that go find another entrepreneur out there. Okay.
Can my side hustle company have other employees that are also owners?
Yes, absolutely. I mean, I presume you would have them as owners anyways. You're not doing it just for the solo K, because that'd be crazy to make someone an owner in your business just so you can do a solo K. But sure, they're just partners. So, and I don't think there's a percentage rule on how much ownership they have to have. They just have to be a legitimate partner in the business. Cool. There might be some kind of de minimis rules the IRS would have if you tried to get away with like 1% or something. I don't know, but I've never seen any rule on percentages.
Cool.
Okay. Let's go back to the slides. I think I got some good ones here.
They are good.
You be the judge. All right. Here's my little diagram here that I talked about a moment ago. That's got, remember, this is your company here. This is you own it. The company creates the 401k. Now the company pays you wages, right? And again, let's presume this is an S corporation, will be the most common, pays you a wage. You then contribute as an employee to the solo 401k. So when you're making an employee contribution, the employee technically is putting the money into the solo K. Now the company could put the money directly into the solo K account as the employee contribution. That's fine. Frankly, that's what your employer does right now. If you have a 401k at a day job, like they just withhold it out of your paycheck and they send the money directly to the 401k. But so either way works. The one that needs to come from the company though is the company contribution. So again, let's say you had a $100,000 W-2, the company's going to put in 25,000. All right. They're going to put in 25 grand for the match, assuming you want to do that much. You could do 10, you could do whatever percent you want. You just can't do more than 25% of what the wage is. So in this case, 100,000, 25%, 25 grand. But that's a company contribution. That can't come from you as the business owner. All right. That's going to come from the company account. Now you funded the solo K with contributions. Oh, but I got an old 401k, Matt, I want to roll in. Cool. You can roll over old 401k money, not Roth IRA, but old Roth 401k could come in. Old traditional 401k could come in. Traditional IRAs could come in. All right. Old employer 403B could come in as well. Those are all funds that could get rolled into a solo 401k. All right. I did skip one thing. Let me go back to Roth solo 401k.
Oh, okay. Yeah, I'm looking at a question right now.
Okay. All right.
On something else. Let's see if you hit it.
I kind of glossed over that. Sorry, guys. All right. Roth solo 401k. In the 401k, you have different buckets of money. All right.
This is key.
Yeah. You have a Roth bucket and a traditional bucket. Now, many of our clients here at Directed will have both, right? They have some Roth money they get in. And remember, that's Roth dollars. That was Aaron, and open up my can.
And now this episode is brought to you by Stop for another sponsor bit. Mike is worse than Mark.
Yeah.
He's like sponsored Rockstar. I'm sponsoring Buy Bubbles. Thank you, Buy.
Yeah. Yeah. So
okay, Roth and traditional bucket.
You got Roth buckets. Sorry, I got distracted there. Roth and traditional buckets. So you can have both. You can do one or the other. Now, to do Roth, that can only be your employee contribution. All right. So when you have the 19.5, you get to decide, do I want that to be Roth or traditional? Maybe I'll do 10,000 of Roth and 9,500 of traditional. I don't know. You could mix it up if you want, complicate it, but most people just kind of pick one or the other on the employee. I'm doing Roth or I'm doing traditional. On the employer money that comes in, sometimes called the match share, this is 25% for the S Corps, 20% for sole props. That has to be traditional dollars because the company takes a tax deduction for it. They have to put it in. And so they can't do it as Roth because remember, Roth dollars, you don't get a tax deduction. So when I take out 19.5 of my, let's say on my S Corp, on my W-2, that's going to go in to the solo K, that 19.5 is, I don't get a tax deduction for it. It still goes on your W-2 and is coded for Roth, but it's not going in as, you're not getting a tax section for it. The company puts money in, is getting a tax section. Now you could say, Matt, but I want to do 58 Roth every year. Can I do that? Yeah, you just got to take a couple extra steps. So you're going to do 19.5 of Roth. And then let's say the other 38,500, you can put in as company match, and it's going to go in a true traditional account. Then you do a Roth conversion of those traditional funds. So the company takes a deduction of 38.5, then you do a Roth conversion, which puts it back into your income. It's taxable of 38.5.
So you're going to get a 1099.
You get a 1099, but you took a deduction on it already in the business.
So it's cool.
It's a wash.
It's cool.
Now that 38.5 goes in with your 19.5 into the Roth account, and you effectively have 58,000 of Roth.
Mega.
That's basically that's one version of the mega Roth IRA.
There's a mega, and then there's like a mega.
Yeah, this is the mega backdoor Roth 401k, I guess you could say. But it's cool for those Roth fans out there. I'm one of them. Getting 58,000 a year into a solo K account that could be Roth dollars. It's pretty awesome.
Can you take the Roth solo 401k and roll that to a self-directed Roth
IRA? Yes. Now here, I'll give you a reason why I had a client do it recently. Here, this is an important distinction between IRAs, Roth IRAs and Roth 401ks in particular. So for the Roth people out there, this is important. Listen to this one. Many people know Roth IRAs have no required minimum distributions. There's no RMD on Roth IRAs, which is cool. Once you hit 72, in your traditional IRA, you got to start taking required minimum distributions. But if you got a Roth IRA, you hit 72, you don't have to start taking money out if you don't want to. You can leave it all invested. In the 401k world, though, everybody's got to take distributions at 72, even Roth 401ks. So I had a client in a Roth 401k that had no other reason to have the Roth 401k anymore. They just used it as their first kind of way to get it going. And they didn't want to have to do RMD. So we just rolled it out. We shut down the Roth 401k and rolled it out to a Roth IRA. And now they're over 72, don't need to worry about RMDs.
It's not the end of the world though if you got to do RMD for that.
Yeah.
Like, it's just got to be accounted for, and whether either we're going to do it or essentially you're going to do it as trustee. That's it. But it just depends.
Yeah. So just keep in mind for solo Ks, you will have RMD even on the Roth accounts in a solo K. You're still going to have RMD at 72. Okay.
Man, we've gotten a lot of good questions, like about 100 of them.
Really?
Yeah. So thank you to the staff here at Directed Ira. They've answered like about half of them.
Okay, cool.
Don't answer them all though. Save us some good ones.
Yeah, we got a crack team. Yeah, save any of the good ones that will really apply. People don't want to hear what I have to think too much. You know. All right, there's a couple other cool things to know on the solo K. So let me hit those. We hit all these points here. By the way, this is all on the website. If you go to the solo K page on the website for Directed, this is just what I have here. You know, you can put over 50K a year in a solo K. You can self-trustee it if you want, have a bank account right there. You got to be self-employed. Remember, we talked about that with no employees other than a spouse or other business partners. And you can do Roth accounts and traditional accounts in the solo K. Pretty cool. But again, there's more. All right. This is where we throw in the steak knives. Okay, there's more. Let me jump back. Okay. Here's something you can do in a solo K you can't do in an IRA. You can take a loan. You can loan money to yourself.
Yahtzee!
Now, in an IRA, I mean, and in a solo K, I can loan other people money as an investment, right?
Yeah.
And that's, you know, note deeds or note investing, promissory notes, trust deed investing, whatever you want to call it.
Yeah. Invest in trust deeds.
Hard money lending. Like your IRA can make loans and get interest and points back to other people.
Which is cool.
Your solo K can do the same thing. What if I want to loan myself money? Well, in an IRA, you can't do that. In a solo 401k, you can. You can loan half the balance of the 401k, not to exceed $50,000 to yourself. It's called a participant loan. You got to pay it back over 5 years. You have to make at least quarterly payments. And you charge yourself a rate of prime plus 2%. But you're paying yourself back. You're paying your own 401k that interest. So we've had many clients use a solo K. I've had many clients start a new business. Mm-hmm. We do an S corp. They roll over their existing IRA or 401k dollars, and then they immediately take a loan out to start to fund the startup operations of that business. Mm-hmm. Maybe they bought a franchise, maybe they need some inventory or equipment to get the business off the ground. They basically just use that solo K to get a $50,000 loan.
Or you bought a company Tesla. I don't know.
Yeah, whatever.
You know, you could have done that. I don't know.
How much was that bought for? More than that, but
you know what? The Model 3s you can get for less than 50 grand now.
Oh, you say you buy it? I thought you buy the company Tesla.
No.
Oh, buy a Tesla itself.
Yeah.
And then go drive Uber in your Tesla.
Yeah.
You could do that actually if you wanted. I mean, that's legit. So that's just cool. You can do. So now let's say you had a $200,000 that you rolled into the solo K. How much could I take a loan out for? Half the balance, not to exceed 50. Half your balance is 100, but you can only get 50. Let's say you had an $80,000 amount you rolled over into your solo K. How much can I take? Half the balance, not to exceed 50. You can take 40. Mm-hmm. You got to pay it back. And if you don't pay it back, you know, you got a 5-year window when you're paying it back. You have to amortize it and pay it over.
Prime plus 2.
Yeah. If you don't pay it back, it's considered a distribution though. You'll pay tax and penalty on the distribution if you screw that up. So
don't screw it up.
Yeah. So pay it back or you'll just have to pay the tax man. All right. All right, here's a cool one for you real estate investors that's self-direct. There's no UDFI.
Okay.
Now, a lot of people I've heard this marketed. Excuse me. They say there's no UBIT. All right, there's no UBIT in a solo K. Well, that's not true. Okay, there's different varieties of UBIT. There's no UDFI, and let me explain. There's really 2 taxes that can hit a self-directed investor in real estate. There's a tax called UBIT, unrelated business income tax, that is a tax that can apply from a number of different things, one of which is UDFI and debt. So the first one is, let's say that I have used my IRA and I go buy a property for $100,000. Mm-hmm. And I use $40,000 for my IRA and $60,000 I get from a non-recourse loan, which is the type of loan you need to get when buying real estate with a retirement account. It's got to be what's called non-recourse. Well, the IRS looks at that and they're saying, you know what, Matt, 60% of that money is not IRA money.
Yeah.
It's not retirement account funds.
Mhm.
So we're going to tax 60% of the profits on this. Just like if Aaron and I bought a property,
Yeah.
my IRA put in 40,000, Aaron put in 60,000 of personal dollars. We make 10. The IRS is going to say, well, the 6,000 that goes to Aaron, he has to pay tax. The 4,000 that goes to Matt's IRA, there's no tax. They're doing the same thing. They're just saying your IRA dollars you don't pay tax on, but the debt money you brought in,
Pay tax.
in this case represented by Aaron,
I pay tax. Yeah.
you pay tax on in an IRA. This is Roth IRA, traditional IRAs, SEP IRAs. They're all subject to this UDFI tax on leveraged real estate. It could be other leveraged assets too, but let's think of leveraged real estate for now. Now, in a solo K, you don't pay that. There's a specific exemption in there. It's been in my book from the first edition. I'd like to say I'm the one that found that back in the day. I don't know if it's true, but no one talked about it until I found that. And that's a big deal for 401k plans and a solo 401k.
Mm-hmm.
For people buying real estate that's leveraged, it's a big deal. Is being able to use that exemption. Now it is limited to leveraged real estate. I've had clients be like, what if I want to buy a business, Matt, and use the loan? Is the real estate you're buying? No, it's a business. You can't do it.
Yeah.
I've had people try to arbitrage and get someone to loan them money in their solo K so their solo K can loan at a higher rate to someone else. Can I do that? Yeah, you can do it. UDFI though. All right, that's not going to be exempt. It's only an exemption on leveraged real property.
Or if I do 10 fix and flips.
Okay, let's talk about the 10 fix and flips. Because that's not UDFI. That's not leveraged real estate.
This is where people mess up too.
This is where people mess up. And this is where people out there just explain it a little too broadly.
So everybody that asks these questions about UBIT, UDFI, how many number of flips, how many number of wholesale deals, this is for you.
Okay, all right. So for UBIT applies to for flips, or real estate development, wholesaling. It applies to IRAs and solo 401ks the exact same. There's no difference. Okay. So let's say I'm flipping 10 properties a year in my IRA. Do I have UBIT? Yes. Basically what UBIT is, it's the tax that retirement accounts have to pay. When the IRS can look at the account and say the account's more in the business of real estate as opposed to investing in real estate. We're going to let your retirement account, this is IRA or solo 401k, we're going to let your retirement account not pay tax on investment income, like rental income or capital gain income. That's all cool. But if you're out there flipping properties, holding them less than a year, buying and selling, and doing a lot of them, the IRS looks at your retirement account like it's in the business of real estate. So it charges this unrelated business income tax to your account. It applies the exact same for 401ks and IRAs. The only exception is this leveraged real estate, solo Ks get out of that UDFI tax, whereas IRAs pay it. But and UDFI is a type of UBIT, so sometimes that's why people get confused.
Yeah.
But I explain them as separate taxes because of this issue, because everybody gets confused. So if you're doing flips, I have many clients come to me and say, I use a solo 401k so I can do as many flips as I want. I'm like, that's wrong. Who told you that? There's a number of companies out there that tell you that. That's not true. It's not right.
What if I only do like 2 flips?
Okay, and this is for IRAs or 401ks. It applies in the same way. What I tell clients that want to buy real estate with an IRA, and our last webinar was on real estate, or we talked about rental properties specifically. Yeah. We should do one on flips, actually.
Yeah, we should. And wholesaling.
Yeah, we should probably do that.
Yeah.
We'll add that to the webinar schedule. But okay, let's say you've got, you're flipping 1 or 2 properties a year. Don't worry about it. The IRS is not going to look at your retirement account, either your solo K or self-directed IRA, as being in the business of real estate. If you're flipping 5 or more though a year, you definitely have UBIT in a solo K or an IRA. And this UBIT tax, by the way, is a 37% tax. Ooh. All right. It's not a good one. Now what did I leave out? Let's say you flip 3 or 4 properties a year. Gray area. Talk to your accountant, CPA attorney, tax attorney, that's familiar with these rules to get an idea. Now, if you was kind of an isolated thing, you sold 3 in a year and the last 2 years you didn't sell any, you're like probably okay. But if you're like, Matt, I want to flip 3 properties every year, am I okay? No. Okay, that's not going to work. 1 or 2, I'm cool with. And this is kind of a judgment thing. This is not in the tax code. This is just from reading every freaking case on this. This is kind of why I feel like I'm comfortable advising clients, and it's kind of turn into a good industry norm. 1 or 2, don't sweat it. 3 or 4, gray area. 5 or more, buckle up. You're paying UBIT.
Yeah. Let me hit on the non-recourse loans real quick for the UDFI. So you can go to the website, directedira.com, go to the Learn tab. You can see where it has some relationships there. You can see some of the non-recourse lenders that, we're cool with, you going and checking out, but that's on your own. You do your own due diligence. But the loan to value, the LTV of how much money they require, typically the IRA to put in, and what the actual lender will put in as far as the debt, typically they want like 50-60% of the IRA funds like going in, and they'll do the other 40 to 50%. That's typically what it is. They want quite a bit of skin in the game from the IRA because it's a non-recourse loan. Yeah.
Okay.
Cool.
Okay. All right. I got one left. Sorry. I just keep throwing it in there. And if you order within the next 20 minutes, we're going to throw in this one. Sorry.
42-piece Tupperware kit.
Yeah. All right.
That was Napoleon Dynamite.
Yeah. My favorite Napoleon Dynamite quote is, "You might as well be doing something while you're doing nothing." Because I honestly say that to myself all the time. That's Uncle Rico to Kip. Yeah, when he's trying to get him to sell Tupperware.
Yeah,
he's like, "You need to come sell Tupperware or whatever." And he's like, "You might as well be doing something while you're doing nothing." That's in my brain.
That's a lot of wisdom.
There's a lot of wisdom to that.
Wisdom.
It's like, I'm always trying to do something while I'm doing nothing. Okay. All right. Okay, here's the last distinction I'll make that again goes in favor of a solo 401k. Let's say you cause a prohibited transaction. We've got lots of stuff on prohibited transaction, a full podcast episode on it, 4 chapters in my book, lots of resources on the website on prohibited transaction rules. Basically, it's something when your IRA buys or sells something with someone it shouldn't, like yourself or your spouse or kids, that can cause what's called a prohibited transaction for the account. In an IRA, the consequence of a prohibited transaction, let's say you got $1 million IRA and you pay yourself $5,000 from the IRA. Well, that's a $5,000 prohibited transaction, but it disqualifies your entire $1 million account.
Whew.
Now, if you got separate IRAs, those are not affected, but that account itself and every asset in it, entirely distributed. We've referred to it. I'm part of a group called the Coalition for American Retirement that has a bill on this to change this. It's actually pending in Congress right now. But we've called this the death penalty for IRAs. All right. Is this dumb prohibited transaction?
Adequately titled.
Yeah, because you could do one dumb little mistake and you could blow up the entire IRA. And so, and it's really like the penalty is not proportionate to the time doesn't match the crime. All right. It's just off. So, and that's actually got pretty good traction, that bill, but we haven't worked on it for 2 or 3 years. I think eventually it's going to go, but this is the rule right now. You lose the whole dang IRA. If you contrast that to a solo 401k, it operates under the employer plan rules, like 401k rules. And the consequence of a prohibited transaction there is, let's say, again, I got $1 million solo K account, $5,000 prohibited transaction. There's only an excise tax on the amount involved. So I have $5,000. I'm having a 15% excise tax. I'm going to pay $750. That's it.
A lot better.
And I have to correct it, which would mean I'd have to return the $5,000 back. If I paid myself $5,000, I'd send the $5,000 back into my 401k.
That was like a sweet get out of jail free card.
Yeah.
With a minor penalty.
Yeah, it's a lot less. Now I'll say this. On the other hand, so that's in favor of that. 401ks are audited way more than IRAs. Okay.
Good point.
There's a 401k department at the IRS, employer plan department that audits them. All right. There's no department in the IRS that audits IRAs directly. All the prohibited transaction cases come in directly through other ways. A transaction got audited, a company that the IRA is invested in got audited. So you've got a lot more audit risk and potential of an audit in a solo K. But if you do have a prohibited transaction, the penalty is much less severe in the solo K than it is in IRA, if that helps.
Well, this parlays into a very good point, which I think is a good point. Like, if you're going to be the trustee versus like having directed act as a custodian, you better have everything in order. Better have the house in order, so to speak.
Yeah.
Because like Matt just said, it's got its own department over at the IRS. So you got to be more organized. There's more details, more things to do. Here's what I'll say, because a lot of you, I know time's short and we're wrapping up. If you need to go connect and go, we have a lot of questions. We're not going to get to all of them, but we'll bang through some for the next 5 minutes and kind of do a rapid Q&A. We have a ton of stuff on our website here to go over we have a whole solo case section that's like, you could spend at least 30 minutes to an hour going through all the content, articles, videos, podcasts, etc. But if you want to schedule a new account call because you feel this is right for you, you can do that as well. And we have 2 solo case specialists in-house at Directed, Solana and Jeff, and you can schedule a free 30-minute quick start call with them and discuss kind of the pros and cons. And we even have the pricing on the page there. So, rock and roll and, or Roth and roll or solo case roll. We just got a lot of quick one-liners over here. So that's what I'll say. And we do have a special promo that Matt had up there. If you use webinar 50 in the account application in section 1, where it asks for a promotion code or referral code, and you can save $50 on the account. So just a quick thank you, easy thank you, an incentive to get going with that. So that's super easy to do. What we didn't hit on? The SEP.
Oh yeah,
we totally didn't do that.
Yeah.
So this is your bonus.
Yeah, okay, bonus round. All right. Okay, let me know if there's any other questions you want to.
Yeah, I'm going to go through them right now while you do that.
But I'll explain the SEP. And a SEP IRA is for a self-employed person. It's generally only used by someone who has no employees as well. Because if you do a SEP IRA for you, whatever percentage you throw in for yourself, you got to do the same for your employees. Because of that, no one really uses a SEP except for someone with no other employees, because they don't want to throw in the same amount of money for an employee, even on a percentage basis of what they made compared to what you do for yourself. So let's say you made $100,000 and you want to put money in a SEP IRA. Well, the SEP IRA, you max out at $58,000, just like a solo 401k. All right. So that's pretty cool. I can get $58,000 in a SEP IRA, but you have to make way more money to max it out. That's why we love the solo K more. Plus the solo K, you can do the loan, you can, you have no UDFI if you leverage real estate, private transaction consequences less, all those perks we talked about, you get in a solo K, but you don't get in a SEP IRA. So we have still a lot of SEP IRAs actually here, just because it's a little easier for some people and they've done it for years and don't want the hassle of a solo K, because the solo K is a little more work. So you can put in up to a total of 58,000. But what you get in a solo K that you don't get in a SEP is you get to put in 19.5 plus 25% of what you make up to a total of 58. In a solo K, you just got to put in 25% of what you make up to a total of 58,000. So let's say you made $100,000. Let's say you're an S corp, and you took a W-2 for $100,000. How much can I put in? 19.5 plus 25% of $100,000, 25,000. So I got to put in, what is that? 44,500. Okay. I got 44,500 in off 100,000 in income. If I was doing a SEP IRA, I made 100,000. How much can I put in? 25,000. You don't get the 19.5 on top of it. You just get 25,000. So, because it's only 25% of what you make. So you can get more in on less dollars in income in a solo K than you can a SEP IRA. Now, some people are like, Matt, I don't care to leverage. I'm not buying leveraged real estate. I don't care to loan the money out to myself. I'm not going to put in more than 25% of what I make anyways. I mean, I like doing more than 6,000 in a regular IRA, and I'm self-employed with no employees. I'm going to just bang out a SEP IRA. Way easier. Does not require a 401k plan or amendments to the plan and all the stuff you do have to do with the solo K, by the way. We just do it for you. It's a form agreement with the IRS for a SEP IRA. And that's how the SEP IRA operates. So I'll say 9 out of 10 clients that can choose between a solo K and a SEP IRA, because it's usually, if you're self-employed with no employees, you could pick between the two. You could do a SEP IRA or a solo K. I'd say 9 out of 10 that are still contributing are going to do a solo K. But again, I could see people that are just like not buying leveraged real estate, not wanting to put more than 25% of what I make in every year anyways. Just roll with the SEP IRA. It's easier.
Okay, this is important. So a lot of people have asked this too. It's a scenario of like what makes more sense. So would it make more sense for Directed IRA to be my custodian versus me being my own trustee of the plan?
Yeah.
If I have like multiple investments, I want a brokerage account, I want to do some crypto as well. Like, what would be the best route? Should I be using directed, or should I be doing it, acting as trustee myself for my solo K? Like, I got all sorts of questions mixed and mingled about that.
Yeah. I always want to slow people down a little bit, just because, particularly if you're new to a solo 401k, it's not like an IRA can be hard enough, particularly someone new to self-directing.
Yeah.
If you want to do a solo K, you got to get your head around the thing. You got to make sure your accountant knows what the heck's going on. Are you contributing every year? How much can you put in? Are you coordinating this on your W-2 and your payroll? Is your company match going on your company tax return as an expense? Are you doing conversions that need 1099s? Are you taking distributions that are going to need 1099s? I mean, there's just a lot that goes into it that an IRA is just like, it's kind of done for you in an IRA. So the first thing I want to say for solo K people is just slow down for a second. I know it's cooler, but once someone's like, I want to buy real estate, I want to do a brokerage account, I want to do crypto, those are possible, but they each take their own effort. And like crypto is going to be a separate account. All right. It's possible to link a wallet to a solo 401k bank account, but you're going to need a consult on that. And those are not easy to do. All right.
Sounds easy.
It sounds easy.
And I know you got the ideas. Like, we got the ideas.
Yeah. Now, if you're like, no, I want to use your guys' crypto 401k option with Gemini, easy. That's why we have it. But you're going to have a separate crypto account to do that. That's going to be separate from your account that you might be doing stocks or mutual funds with, or buying real estate with. Now, some clients are like, Matt, I just want to buy stocks and mutual funds. I don't even have a self-directed investment. Cool. You can do a solo K at TD Ameritrade for free.
Mm-hmm.
I mean, you could do a solo K here if you're like, well, I don't know what I want to do self-directing. I want to do real estate or invest in a private company or crypto, but I don't have an investment yet. We do have a brokerage option that you could just get invested in some stocks or mutual funds, so you're not just sitting in cash. We have lots of solo K clients that do that. We just add a brokerage account option. You submit us a form and say, go buy XYZ stock for my account or ABC mutual fund, and we go buy it and your account owns that. But frankly, if that's all you're wanting to do, we're going to be a little more expensive than other places, like a TD Ameritrade or Fidelity or these other places that do offer solo 401ks. So, or what you could do is just, and by the way, those places are not going to help you with tax reporting either. Your accountant's going to have to be involved in that. Or you could just we set up the solo K and you self-trustee it. And you can go open a brokerage account. If you want to day trade, you could open it directly at Fidelity under our solo K plan documents. And you could just day trade, and then you have a bank account. You're like, I want to link a crypto wallet to it. Cool. But remember, you got to make sure you understand the reporting requirements. You'll need plan amendments, and we have a compliance plan. If you're like, just give me the plan amendments, I'll make sure my accountant's doing the tax reporting. If I take a distribution or when my account gets over 250,000 in assets, I know I got to file the tax return for the solo K. I'll just work with my accountant on that. That's cool. And lots of clients just do that. So again, this is like the same thing with the IRA and solo K. There's not one thing's better or easier. It's just like, what do you want? And that's what we're trying to do. Directed is like, do you want total control and you just want to do it yourself? Cool. But you're on your own. I just want to make sure that, like, sometimes people are like, they choose the annual compliance plan is what we call it. And they're like, but then they want us to do everything for them and help them and answer all their questions. It's like, well, guys, remember, you're not paying us. You decided to the do it yourself option. So do it yourself. Or if you're like, no, I want you guys to do it, do an account here. We in order for us to really do it accurately and properly, we've realized we have to custody everything. But then we know it's good. It's going to get the tax reporting. If you're doing Roth conversions or distributions, we'll automatically be doing the 1099s. We'll automatically do your 5,500 if you're over 250,000 in assets. Like, we're on it. You're going to get quarterly statements. They're going to be accurate about what money you're putting in and taking out, that your accountant's going to love because it's going to show what the heck you've done. So, so it just depends on what you want and just kind of your style. And I don't know, if you're like, well, I'm kind of semi-retired, I got the time to do all this stuff and I love it and I just like it, cool. If you're like, I don't have a minute to spend on this, pay us. It's not that much more. I don't know. That's a terrible answer because I realized that once I said it, and it's because it's up to you, but we have options.
So this is funny. I love it when people reference other people's questions. Like, I got the same question as so-and-so.
That's good.
So-and-so. If I'm we'll do two more. And we'll wrap it up. If I'm currently self-employed and set up a solo 401k, but later I hire full-time employees. Can I convert my solo 401k to a regular 401k, or do I just end, or do I just add, I should say, a regular 401k plan in addition to my existing solo K?
Okay, that's a great question. We've had this happen.
Yeah, recently.
Every month I got somebody that has this problem for a solo K, which is great. That means your business is growing. You're adding employees.
It's a good thing.
I mean, this is the heartbeat of America right there. That's
thing.
cool. I love that. So, but people are realizing you do have a solo K problem now.
Yeah.
So, a couple thoughts what you could do. First, if you just got 1 or 2 employees, a 401k is kind of heavy to do for just 1 or 2 employees. You could do it, and I'm going to explain that next. But first option is freeze the solo K. You don't contribute anymore, and you get a few years where you can just keep it as a solo K. Now, remember, employees, they must have worked for you for a year and be full-time. There's a new requirement that came into effect a year or so ago that is part-time and worked for you 3 years. So if you got a full-time employee, which full-time is about 20 hours a week under this rule, that's worked for you for a year, and they're over 8, they're 21 or older, that qualifies as an employee. But if you're like, no, my employee's 18, don't worry about it. They've worked there for 2 years. Don't worry about it until they hit 21. All right. Or let's say it's like, no, I got some people that work 10, 15 hours for me. They're employees, but they've only been here a year or 2 and no one really stays 3 years.
Yeah.
You might be outside of it too. What if I get people I just 1099 that are legit contractors?
Yeah. On my fix and flip business.
Yeah, totally fine. They're not employees. All right. So,
and I got 20 of them.
Yeah, that's okay. They better just really be independent contractors. Okay. And they work for other people too, I presume, and stuff. So you're passing all these tests.
My roofer, my electrician, my floor guy.
Okay. All right. I'm cool with that. Okay, but let's go back and say they are an employee. I was just trying to give you some ways you might.
Well, you need all this context.
Yeah, I want to make sure there's ways you could maybe avoided this in the first place and bought yourself some time.
Exactly.
Okay. Let's say you do have the employees. They're over 21, they've worked for you for a year. We got the freeze option, and you can have a few years. There's no hard and fast rule from the Iras, but they do expect you to wind down the 401k and eventually roll it out to an IRA. But you could probably get away with keeping it solo K for, I wouldn't do it more than 3 years. You do have to freeze it so there's no contributions, and so it's clear your employees wouldn't be able to participate, nor could you anymore. But you're just working with the dollars that are in there. Eventually, though, you're gonna have to do something. Now, let's say you're like, nah, I don't want to freeze it. I just want to do what I need to do now. Okay. Option 1 would be what was suggested. Do a 401k plan for the company as a whole. All right. And the most common is what's called a safe harbor 401k, but you want to self-direct. Now, this is the hard thing. And quite honestly, this is a nut we've been trying to crack for years, and I've helped a number of clients do it, but it's hard. It is not easy to self-direct in a 401k plan with employees. We do it. I do it. The 401k in our law firm that I've done for years, which is where my account is, that I self-direct, and every other employee just buys stocks, bonds, and mutual funds for the most part.
Which is okay.
Which is fine. Like, I do it. It's even hard for me though. I mean, I do this all day. So it's possible, but it's a little tricky once you do have employees to still be able to self-direct your account, but have a 401k available for your employees where they can just buy stocks, bonds, and mutual funds, which is what they're going to want and what you're going to have to offer them. You're going to have to give them that option and like readily available investments. So if you go out there and you call up any 401k provider and you're like, yeah, I want to self-direct and buy real estate with my 401k, but I want my employees to buy stocks and mutual funds. Can you help me do that? I mean, you're just not going to get good response. If you get a good response anywhere, please tell me. If you find that unicorn, tell me, capture it, and we're going to go duplicate it. But it's just a little tough one to do. I don't know how else to say that. So it's possible though. I probably got 20 clients that do it.
Yeah.
But you got to be really committed to doing it. And there's a way you can do it. I know how to do it. I'm just saying the mechanics of it is just kind of a pain in the neck because you're really doing a couple of different things. You're having self-directed accounts over here. You're doing payroll stuff with your employees that's going over here. You then got to coordinate it back so your accounts know what's going on for your 5,500 because you got to coordinate 2 different buckets of things. But it's possible. We've done it. So And let us know. We got some places to send you if you're in that boat. And eventually we're going to perfect that. That's on something I've been wanting to do for 5-10 years, actually.
Yeah.
It's just the freaking 401k industry is tough. In the IRA space, we can control it. And eventually we'll get there. Just saying it's tough.
Let me hit on this. Can
I give one other option?
Yeah,
Let me give one option. Just do a regular 401k with your employees, roll the solo K out to an IRA, and just start doing a self-directed IRA for you, and do your 401k stuff over here with your employees where you're just buying stocks and mutual funds.
Way to bring it home.
There you go.
Way to bring it home. So the same investments apply to the solo K just like they would a self-directed IRA. So if Eugene, you want to invest your solo K into a privately held trucking company, cool. So same deal. You just can't do, life insurance, certain collectibles like your wine collection, can't do that. And S Corp stock. So, but other than that, you're doing the same types of investments like you would in a self-directed IRA. Okay, last question. Does my business have to keep making money every year? And the second part to that is, do I have to always make contribution, both employer and employee contributions every year? And we're going to end it on that.
Okay.
We're going to end it on a high note.
Good, because I got good answers for those. That one before I got employees. I know it gets complicated. I don't have a nice answer to that.
We're going to bring an easy one in.
This one, there's good news. So you can vary it. So let's say you have 1 year with good income and you want to contribute. Cool. Next year you have a loss. I mean, a lot of our clients, 2020 was brutal with COVID, and a lot of them didn't make retirement plan contributions. A lot of solo K owners. That's fine. That's cool. You're going to have a loss that year, possibly, or even if you didn't have a loss, you just didn't have the money you wanted to set aside and put in a retirement account. You're not stuck to a specific amount every year, or even a formula that you're withholding this much from your paycheck, like you may have to have done at another 401k or somewhere you worked. So it's totally up to you. Now, let's say you want to do some employee and employer. Cool. Do whatever piece you want. You just can do up to 19.5 employee and the 25% of what you paid yourself on W-2 for S Corps, or 20% for you sole props, or don't. It's fine. The IRS, they're either way. The nice thing is our plan document, our law firm that has the plan document, it's an IRS pre-approved plan, which you have to have, by the way, and we have a certified letter from the IRS about it. It's going to have, we've kind of made it is to be like a Swiss Army knife. So whatever you want a Roth account, you want to do Roth conversions, you want to do after-tax contributions, you want to add additional employer, you want to contribute some years employer and some years only employee, or some years employer and some years no employee. Fine. I mean, it's all possible because we kind of made it open, universal, so you can do whatever the heck you want as long as it fits within the rules, which all those things do. You got total flexibility.
That's awesome.
Cool.
I think we did it. Okay. So
remember, we got the special $50 off for a self-directed IRA. That could be SEP IRA, regular IRA, or custodial solo 401ks. If you do a solo K and you want an account directed to track all that solo K dollars,
we'll do it.
Have us do your 5,500. Solana actually is the one that does those and has been on here answering a lot of questions.
If you have crypto questions, then set up a consult, because we do have a crypto custodial solo K option as well. So, and you would just be connected with, we use Gemini's exchange currently. So that's the option at the present moment, which is great because they're also a licensed trust company, which is partly why we like them. So go ahead and connect with that. So if you need to schedule a new account appointment, go do that. If you got more questions, we'd be happy to answer them. As always, I'm Aaron Halderman, Directed IRA.
Matt Sorensen, same great place, Directed IRA.
And we're here live.
Yeah.
We're here live. We're live in Phoenix.
Yeah.
So
thanks, everybody. Just get to the site for more details. You know where to find us. Did we decide what we're doing next month for the webinar?
I don't.
Stay tuned.
I don't know, but we'll announce it shortly. So we do these every month. We do them live, and then we'll have the recording and the PDF of the slides that we used. And yeah, we always got cool topics. They're a little bit different than the podcast, a little bit more interactive, and a little bit more lengthy in time. So thanks for hanging with us. We appreciate it. So we'll see you next month.
Adios.
Bye-bye.